Welcome back again. Our second session this morning is called Managing Mortgage Debt During the Financial Crisis. We have two great papers. So our first presenter, Lauri Kytömaa from Cornell University. All right, go.
Thank you very much. Good morning, everyone. It's great to be here. I've spent a lot of time presenting to people who don't know who mortgage servicers are as an entity. So it's nice to be at a mortgage conference where I can kind of blow through some of those institutional details a little faster. Okay, so just to introduce, and I mean, a lot of this background is familiar to almost everyone in this room, but there is a general, so this paper is all about mortgage foreclosure prevention in the residential setting. Okay, and so there's a general perception in both the literature and public policy realms that mortgage foreclosure kind of exceeded socially optimal levels coming out of the financial crisis. Okay, so even setting aside externalities on third parties, the parties directly involved in a foreclosure, the borrower and maybe the debt holders, setting aside securitization a little bit at first here, there's a question of why can't borrowers and mortgage lenders or the holders of debt reach some kind of mutually beneficial agreement that gets us out of foreclosure overall. So borrowers obviously are kicked out of their homes, severely hampered in credit markets, not going to be able to take on a mortgage for close to a decade if it's a GSE mortgage. And papers have also tied the event of foreclosure for the borrowers, to increased rates of depression, suicide, divorce. So very painful for the borrower. But if we're in a financial crisis, the debt holder is also suffering tremendously, okay? So they're not housing inventory companies. They sell it pretty rapidly through foreclosure auctions. Coming out of the crisis, we were losing in the order of 40 to 50% of the principal balance through a foreclosure. Okay, so that creates at least the intuition of why can't we take a bit of a haircut? We lose less than 40%. Maybe that becomes more affordable for the borrower, and we avoid the foreclosure altogether. Okay, and then you add third-party externalities, and this is a bit even bigger question from a social policy perspective. Okay, so there are in the order of 8 million foreclosures that have happened in the decade between 2007 and 2016. And as we talked about yesterday, foreclosure is a very long process. These elevated levels of foreclosures lasted well past 2008. Okay, so numerous market frictions have been studied by people all over this room. One of which is the role of securitization. So maybe it's hard to change the loan terms because this pooling, MBS pooling structures protect the investors, and we can't give discounts to borrowers to achieve this kind of mutually beneficial gain. Okay, but there are still numerous questions around the potential strategic borrower behavior and the role of information in this setting, which are often discussed in introductions and conclusions of papers, but are not always formally addressed in the modeling techniques. Okay, so this project is going to address a gap in the literature about the role of information asymmetry in the debt relief process, where this debt relief is granted through loan modifications, and how this interaction is going to affect foreclosure outcomes in kind of an equilibrium concept. Okay, so the research question is one that has been asked before, most prominently by Manuel Adelino, Christopher Girardi, and Paul Willen in their JME paper, is what is preventing, and servicers, I have banks here to be more friendly to people who don't know who servicers are, what is preventing servicers from granting debt relief to struggling borrowers? Okay, what this paper is going to look at is 3 specific channels that are all interacting with one another. So first, I'm going to be thinking about information asymmetry. And for me, the information asymmetry problem in this paper is that borrowers know more about their financial health than the financial institution does. Okay, so obviously financial institutions know a lot. They know your income, they know maybe if you lost your job, they know your credit score, where you live, value of the property, but they don't know about maybe your access to informal credit markets through friends, family, relatives. They don't know differences between your moving costs and another person's moving costs, maybe your children in a school system. Okay, this information asymmetry is going to create some scope for saying you're distressed when you're not. Okay, and financial institutions are going to worry about giving relief to borrowers who maybe don't need it. They could have paid the full amount, even if they say I'm at risk of imminent default. Okay, secondly, I'm going to be thinking about transaction costs, and these are going to be quite broad in economic sense. So, I mean, firstly, you have to pay someone to process paperwork, look at what the borrower submitted. But there are also maybe legal costs. Yeah, maybe the investors are going to sue you because you changed the mortgage terms and now they're losing some money through that. There may be capacity constraints kind of in here too. So maybe one more modification is just prohibitively expensive because you don't have enough staff and you can't gear up your staff fast enough. Okay, so that's even if you have all the information in the world, maybe these transaction costs are important here. Okay, finally, and maybe most obviously, think about relief sufficiency. So the program set a certain target for debt to income ratio to help borrowers. And if maybe that wasn't sufficient, maybe you need a huge cut of your mortgage to stay solvent and be paying your mortgage. And at some point, the debt holder is going to prefer the foreclosure loss over a really lucrative relief offer. Okay, so all three of these things are going to be featured in a model that I'm building here. So what this paper is going to do, it's going to introduce a structural model of foreclosure prevention in which a financial institution or a bank or a servicer, I'm going to be using servicer, sets a relief policy without knowing everything about borrowers. Borrowers are going to make repayment decisions knowing some private information and having information about the policy. Maybe I make $10 million, maybe I'm not going to get debt relief. Okay, and then banks, crucially in this model, are going to face different costs of processing relief. This is going to matter a lot for identification, but it's also going to pick up the fact empirically that different financial institutions treated borrowers very differently, even though they looked observably the same. They lived in the same place, they had the same FICO scores. The probability of granting a modification was vastly different. Okay, I'm going to estimate this model using California mortgages originated prior to 2008. I'm looking at California because foreclosure policies are so different across states. There's nothing stopping me from taking this model to other states, but California offers the largest sample. But I do need to say kind of the numbers coming out of this model, you can't just multiply the results by Massachusetts because the story is very different. Okay, I'm going to be leveraging rich loan level performance data from Fannie Mae. And so these are prime market loans and not subprime. And prime in this setting is actually nice because I can focus kind of on the mechanisms I introduced on the last slide in a cleaner way. There's more documentation. The underwriting standards are more similar. I also rely on an assumption that the borrower kind of distributions across servicers are similar. And so selection into conforming loan limits is helpful in this project. And then, so I'm going to take this model and then study the home affordable modification program. And so servicers associated with Fannie Mae were required to participate in HAM. Okay, so that's also a helpful feature of using this prime market data rather than, and GSE data rather than just private label, where they had more flexibility in how they were behaving. Okay, so I'm going to go a little faster here because most of you have heard of loan modifications, but so you could think of about it as kind of a lucrative refinance, and you're generally not going to be eligible for a refinance if you're in 90-day delinquency. And so the three levers, like in a refinance, are we change the annual interest rate, we change the term, or we change the principal. I mean, the most common loan modification in my data is a term extension and an interest rate decline. I mean, I know some people have studied also principal reduction programs during this time, but principal reductions are relatively rare in the sample that I'm looking at. And so in practice, reducing the interest rate and extending the term translated typically about $300, $400 decline per month on the loans. And these were NPV losing modifications. Okay, but again, the 14% loss in this example is not being compared to 0% loss. It's being compared to maybe a 40, 50% loss at this time through a foreclosure. Okay, so at the center of this project, and I'm not going to show you very many equations today, given the timing, is this kind of policy setting game between the mortgage servicer and the borrower. Okay, in 3 stages. So this is not going to be fully dynamic. Okay, so the servicer, we start with the servicer setting a policy of what is the probability that I'll give you this modification. And some of the rules of the modification are going to be exogenous because the federal government was prescribing some of the targets that servicers had to be achieving at this time. Okay, but the servicer I mean, there were so many lawsuits at this time, it seems that servicers had some way to maybe make you wait on the phone so long you gave up. But so here the servicer is going to set a modification probability that's conditional on your observable characteristics, your credit score, your income, and some distribution of unobservables, which on this slide is this G theta. Borrowers are going to observe that policy, the likelihood that I get a modification from the institution. And they're going to observe their private information, then they're going to make a decision, do I go delinquent or not? Here, my definition of delinquency is like 90-day delinquency. So this is, some people may call this default, but this is really where the action starts with loan modifications, at least in my empirical setting. Okay, so if you don't go delinquent, this game ends, everyone gets kind of a repayment associated with not entering foreclosure or something like that. And if you do go delinquent, then you realize the outcome of this modification policy. Okay, that's a move of nature here. Crucially, I mean, it is a choice, but some borrowers, the opportunity cost of paying their mortgage may be so high, you're deciding I need to buy food this month, or I drive to work, I need to pay my auto loan. Some people will just, if you're truly distressed, you're going into delinquency. But some borrowers may have a strategic choice to say, I'm going to go delinquency because I get a shot at this modification draw. Okay, then finally, there's going to be a default decision. Again, if you're really, really distressed, you're just, the value of defaulting is going to exceed the value of paying your mortgage. And the servicer and the borrower are going to get some payments for that. So I mentioned transaction costs. So I have a C down here whenever a modification occurs. And so this is an area where if you know for sure the borrower is going to default, you would rather not modify to avoid that transaction cost. And this is where subsidizing these institutions may reduce some of the costs and incentivize the servicer to help the borrower, all else equal. A quick comment. So I'm not going to show you equations, but where I'm gonna implement rich heterogeneity on the borrower's kind of delinquency cost, your willingness to go delinquent, and on your willingness to go into default and lose your home, which is synonymous in this paper. I'm going to allow the servicer to know more than me as the econometrician about your probability of default, which is really important because in my data, I can't see the interaction between the servicer and the institution where the borrower says, I lost my job or I got a divorce. And that's why I'm at risk of imminent default. Okay, that's going to create a need for something like an instrument because I'm going to have selection into the loans that get modified because the servicer is awarding modifications to people with information I can't see. Okay, but in this setting, that's really important. So I'm going to have a component of servicer known unobservable heterogeneity and borrower strictly private information. Okay, I don't want to repeat too much on data, but so Californian loans, I'm focusing on loans originated prior to the crisis. So origination is not in that model I showed you, but I'm trying to shut down the idea that the existence of HAMP changes the origination story. Borrowers think, now there's HAMP, maybe I'll get bailed out if I take a really risky mortgage. And because during the crisis, I mean, mortgage lending changed dramatically. I'm going to track those till 2019. And this is a really important part of the paper is that we're in 2024 now. Any mortgage paper written in 2010, 2011, by no fault of their own, faced a lot of outcome censoring because foreclosure is such a slow process. Again, foreclosures were at elevated levels well into 2013, 2014. Okay, so 2008 is a long time ago, but 2014 is not as, I mean, it's still 10 years ago, but I get this benefit and why I'm able to talk about foreclosure explicitly is now I have like the whole time horizon leading into kind of COVID. And most of these loans are terminated by that time. Okay, the loan level panel, I'm sure people are familiar with this, but I have very rich information at origination. Although I can't track something like a FICO score over time, and that's why another reason I need to have the servicers know more than me as the statistician here. And another great feature is really detailed foreclosure information about what are the sales proceeds and costs associated with foreclosure to think about those losses. Okay, and then I'm going to supplement this with HFA data and BLS data on unemployment. Okay, so very quickly, I estimate this using simulated maximum likelihood, so I'm going to have to put some parametric assumptions on what is the distribution of unobservable information. I'm going to take draws from those distributions, and then I'm going to form probabilities of the 5 outcomes that I showed you in the model. Okay, and so the intuition is I'm just trying to get the probabilities implied by the model as close as I can to the data. Okay, and I'm happy to talk about parameters afterwards. Okay, so I got time to show you 2 things. So I want to show you kind of what is the point of this whole exercise. So here I have a matrix where the rows are, did we end up in foreclosure, yes or no? And the columns are, did we award relief, yes or no? Okay, this is just data, observed outcomes. Okay, and I'm conditioning on you've already gone 90 days delinquent, so maybe you're already struggling here. Okay, this is language from the Adelino Girardi-Willen paper. So we have people who self-cure, so they didn't get relief, but they avoided foreclosure. We have redefault, so you got relief, but then you ended in foreclosure anyway. And the point of that paper is that if self-cure rates are really high or redefault rates are really high, institutions aren't going to be very interested in granting assistance. Okay, so the first thing to note is that the top left and the bottom right, we have these certain types, even in the observed data, where in the self-cure cell, we can counterfactually imagine, what if we gave relief to everyone in this self-cure cell? It doesn't take a huge leap of faith to say, we could imagine that these borrowers, we make it better, we give them a cheaper mortgage, they would probably avoid foreclosure as well. The bottom right, we have these borrowers who got relief but entered foreclosure. So counterfactually, we took it away, they'd probably end up in foreclosure as well. Where we start getting some bite is at the top right and the bottom left cells. Okay, so now this is a counterfactual from the model. Okay, at these cells, we have mixes of types. There's this needs a borrower who fundamentally needs the assistance to avoid a foreclosure. And this is from a social perspective, the guy's social and private perspective of the institution itself. These are the guys we want to help. Okay, so I mean, these numbers depend a lot on samples. In the paper, I go through different origination cohorts, estimating this model. This is for the 2004 Q2 cohort. But we can see for this cohort, banks seem to do a pretty good job. I mean, in this cure cell, the vast majority of borrowers really needed that aid to avoid foreclosure. Okay, and maybe we made some mistakes. So maybe this never defaulting type of borrower, we would have preferred to not grant assistance and they would have self-cured. Okay, but I want to be really careful. I don't want to call these guys strategic because you could have had a liquidity shock that you bounced back from. Okay, so this is going to be an upper bound on strategic borrower behavior, like strategic delinquency to get modifications. Okay, so this is pretty low. So, and this is consistent with Tomasz's paper with Emmett Saru in the JPE, where they found the HAMP program didn't have too much strategic behavior. Okay, we go down the bottom left, we can see the vast majority of borrowers that defaulted could not have been saved by the level of relief under the program. So this picture is conditional on a level of relief given under HAMP. We could increase the level of relief, and some of these always defaulters would maybe become needs aids or a different type of borrower. Okay, so there's a sense of type 1 and type 2 errors. We want to modify the people where we can shift them out of foreclosure, and we don't want to modify people where it doesn't change the equilibrium outcomes. And so we make errors ex post, and obviously we're never going to get to 0 ex post errors. But we make mistakes when we award relief to people who didn't need it. So this always defaulting type, oh, maybe they needed it, but they entered default anyway, or this never defaulting type. And this is another important source of kind of identification here is I know this ex post information the institution can't have when they're making decisions. But this reflects kind of how accurately they're targeting it. Okay, I have enough time, so I'm going to show you. So this exercise could be done in a reduced form way. Okay, you have an instrument for modification. So we're moving around modification in a way that's unrelated. You have an exclusion restriction from the borrower's default likelihoods from an unobservable perspective. So we could get some of these numbers, but we need an equilibrium type of model to really run big counterfactuals because I showed you this is conditional on delinquency. If we suddenly make the program more generous, we're going to have more people maybe entering delinquency. or we say we're going to reduce the standards of granting you relief, the borrowers entering this matrix are going to be different. We may have more of these never defaulting types going delinquent in a strategic way, potentially. Okay, so moving around things and trying to play with policy is not going to be possible with simply a reduced form approach. So I'm going to show you one of the headline counterfactuals here where I start thinking about, I can move around how much information we have and how much we're subsidizing institutions. Yeah, I have some welfare implications in the paper, but I'm not going to have time today to talk about those. But so here, we're going to have on the x-axis additional subsidy per loan modification. Okay, so at 0, we're kind of in the order of $4,000, $5,000, which was kind of the size of subsidy being given to institutions at this time. Okay, so I mean, 20,000 subsidy additional on the 5,000 is a huge increase. Okay, but, and then the y-axis is the share of preventable foreclosures stopped. It's a little bit of a mouthful, but it's given a level of relief, generosity, how many can we stop? And so if we just pour cash into the servicers, they can stop all of them, but this is going to be not very efficient from a welfare perspective. And then if we make it much more expensive, so this is kind of raising the transaction cost of modification, eventually the servicers don't find it worthwhile to help anyone. Okay, so one of the estimates here is that for this sample, we were preventing about 64% of preventable foreclosures, given the relief law. Okay, so that's pretty good. We can say, let's take away the government subsidy. So this is kind of an average. Let's take away $5,000, and we see actually the share of preventable foreclosure stops drops by 10 percentage points, which actually is pretty significant. I think in California it's in the order of at least 50,000. I have to check the number again because it depends on national or country. Okay, then we can start moving around. So this is just moving around how much we're subsidizing. So this red line is the level of private information that I estimate in the model. And I didn't show you a lot of equations, so talk about it afterwards. But so I could say, what if they have perfect information? Okay, if they have perfect information, actually institutions have a really strong private incentive to stop foreclosures because they kind of know who to target to until transaction costs get really large. And then they say it's too costly to do this. Okay, so actually if institutions have almost perfect information, we don't really want to subsidize them. Okay, because this is pretty flat. When we move around subsidies, it doesn't change anything. This upward sloping line is actually hopeful because subsidizing them does change equilibrium foreclosure outcomes. Okay, and then we can say, what if they have less information? So I'm kind of increasing this variance to make it a little more tangible. It could be, what if we take away information about income, about credit score, about where they live? Okay, eventually, the banks just don't know who to allocate the aid to because they don't know enough about them. There's too much private information. And so this starts to get flat again. And we have to subsidize them tremendously to be able to make them willing to modify. And they're basically modifying it. It's not necessarily going to the right place. If the information level is like this, we don't necessarily want to pursue a subsidy policy either. Sorry, my buttons don't work as well. Okay, so all right. So I'll close here by saying I think going through this project and depending, I mean, this is a kind of financial crisis project. Okay, I mean, foreclosures aren't a big issue if home prices are way up and you could just sell your home to clear your outstanding balance. But I think in a setting where we're seeing declining home prices, like we saw in the financial crisis, that really can be a really powerful tool to help borrowers survive. But some of the most policy actionable things, like subsidizing the banks or saying we're going to be more generous, are going to be heavily contaminated by how much information the banks have. Okay, so I showed you if the banks have no information, we have to give them huge amounts of subsidies to preventing foreclosures, and they're not going to be allocating them to the right borrowers because they don't know who to allocate it to. Same with relief sufficiency. We don't know who to allocate the aid to, and we make it suddenly much more generous. We could save more borrowers in theory, but we might also have more borrowers behaving strategically because they know the institutions don't know who to allocate it to. Okay, so I'll close by just highlighting, I think there are a lot of interesting avenues for research thinking about this moving forward. And I think the importance of timely relief is something I'm working on with a co-author at the moment, which is during COVID-19, we saw the PPP loans being distributed very rapidly. But increasingly, the literature says it went to kind of the wrong people, maybe at the higher end of the income distribution. And a lot of the institutions were just giving these loans to people they already had pre-existing relationships with, maybe because they knew more about them. And so if we do something really fast, is there a trade-off? That's maybe the first question, between gathering information and targeting it correctly, and then maybe saving people who are really liquidity constrained and may take default on other debt too if they don't get aid fast. All right, thank you very much for including me in the program, and looking forward to your comments.
So I just want to thank the organizers for asking me to discuss this paper. I very much enjoy it. It's a very nice piece of work, and I encourage you to read it as well. Let me first put the paper a little bit in a broader context of what happened during Great Recession and the associated literature. So for those of you who are old enough to remember this, let's remember the Great Recession. We had millions of foreclosures, more than 6 million. We had slow recovery in terms of spending, persistently high unemployment, persistently low house prices. And this is all despite significant stimulus and debt relief measures like low interest rate, quantitative easing, and various debt relief programs, including two main ones, HAMP and HARP. So why do we care about foreclosures specifically? Well, you could think about foreclosures as a risk-sharing mechanism that allows to discharge debt to borrowers that cannot pay, but we worry about them because of the associated costs, not only to the borrowers with potentially some negative externalities, but also directly to the lenders. So think about what lenders recover from at least some foreclosures. This is an example. The home in the middle went into foreclosure in 2009. This is what the lender was able to recover. So the question is, if foreclosures are costly, why did lenders not renegotiate more loans to avoid foreclosure? So the first thing an economist would think about it is asymmetric information between borrowers and lenders and moral hazard issues. So the problem is, if I become too generous in renegotiating mortgages, yes, I do benefit in terms of a lower foreclosure cost because I don't have to foreclose as many properties, but then I can encourage borrowers who would otherwise make payments to default to qualify for it. Let me just say this is a real friction. I did some work on this myself with my co-authors. Let me just give you an example. Countrywide Financial announced in October 2008 a widespread modification program that, if you were delinquent as a borrower, you could qualify for a debt relief. And what we find out, essentially a significant share of countrywide borrowers defaulted to presumably qualify for debt relief program relative to other servicers. And that just shows you that this is something really real, and the borrowers act strategically. I just want to mention this. I would encourage you to also look at an associated work by Adelino Gerardi and Willen, but also sort of emphasizes this point in the context of Great Recession. The second friction is that a lot of delinquencies and defaults, especially early in the crisis, were concentrated among securitized loans. And here there is a separation of ownership and control problem. The servicers that deal with these loans do not necessarily have the right incentives to act on behalf of investors and modify these loans accordingly. And we know that there's a lot of evidence on this, that loans that were securitized were foreclosed at a much higher rate and renegotiated at a lower rate relative to similar loans that were held by banks. So, and then finally, there are organizational, financial, and financial servicer constraints to modify loans. Just to show you, there's a huge variation across servicers in modification intensity that's not accounted by borrower, loan, or regional characteristics. It's actually related to the organizational ability of the servicing divisions. And in fact, in our work, we showed that this variation and limited organizational capacity to deal with distress was a very important impediment in implementation of home affordable modification program, because the program was quite complex, asked a lot of verification criteria, and some services were just not able to do it quickly enough. And this debt relief frictions are compounded by frictions in pass-through of lower interest rates to households. In a way, if we had a quick pass-through, maybe we wouldn't need as much debt relief, but the predominant contract in the United States is fixed rate mortgage. Borrowers do not immediately benefit from lower rates. If they want to get a low rate, they have to refinance, but there was this equity refinancing constraints that prevented a lot of them from doing that. And it's not inconceivable if you take all these frictions into account that they could have contributed to 50% or more foreclosures, and of course also affected the effectiveness of debt relief programs, but also try to address these frictions, at least in a partial way. And more broadly, we also know that the areas that receive more debt relief recover faster. This is just an example of consumer spending measured by auto sales, but also the same thing holds for recovery of employment, recovery of house prices. So the debt relief could have these broader macroeconomic consequences. So how this paper fits in this broader literature, it revisits the design of foreclosure prevention policies. What is nice, it really incorporates several frictions. There's asymmetric information, the transaction cost of modifications that capture also this variation in servicer ability to modify loans. There's a variation in net generosity, and we have also variation in the cost, including deadweight costs of foreclosures. What is really nice about the paper, it considers this in a structural model that is estimated using data. So this is an important addition to the literature. Most of the literature in this area has used, has been empirical. There's some structural work too, but this is a really step in a nice direction. And in terms of the data, the author uses the mortgages originated pre-crisis and looks what happened to them. This is about 52,000 loans from California, the prime fixed rate mortgages. So what are the main findings? So the other finds that HAMP increased debt relief, decreased foreclosures nationally. However, information frictions and other frictions contributed to limiting the program effectiveness. And let me say that on a sort of a broad level, I very much agree with this conclusion. In our work, we found that the HAMP increased modification rates. However, it was significantly hampered by various frictions, including servicer ability to deal with distressed loans. What is really nice about the paper, the author also considers welfare analysis. Given the existing contracts in a paper, the benefits of modification can outweigh the direct benefit to financial institutions or lenders. This is because due to the loss of the borrower's welfare in foreclosure, some of this loss just is a private costs that are not internalized by the servicer. And if this gap, the benefits of modification become bigger if you consider negative externalities of foreclosure. So let me make a few comments on the paper. First, let me start with the modeling framework. The one comment I have currently, the paper essentially assumes the servicers are benevolent in the sense that they maximize loan repayment subject to modification costs and the borrower's expected response. So in other words, they really act on behalf of the owners of the loans. But we know that a lot of distress has been concentrated in securitized loans, and there's this separation of ownership of control on it. So the servicers maximize value of their servicing income, which may not fully align with interests of loan owners. Think about MBS investors or GSEs for agency loans in terms of the guarantees of credit risk. And taking care of servicer incentives is an important part of debt relief design. A second comment is on, I know the model is already quite rich, but it would be nice to consider richer and potentially more dynamic setting, and in particular, to allow analysis of a richer space of debt relief actions. In particular, things like permanent versus temporary reduction in payments, or simpler policies like temporary debt forbearance. Why this is important? My read on the Great Recession literature, and a lot of people in the room have done a lot of great work in this area, is that the temporary liquidity support is really can be quite effective versus permanent modifications like principal forgiveness. And importantly, we have further evidence on this. Between Great Recession and now, we also have COVID-19 crisis. And what is different in terms of COVID-19, in some ways we internalized the lessons from the Great Recession. The response to COVID was much quicker. During Great Recession, it took more than 1 year to pass the debt relief programs. In COVID-19, the CARES Act was passed within 2 weeks. And importantly, the debt relief was provided in a very different manner. It was a very simple program. Borrowers just need to request forbearance, and there was no costly verification, unlike under HAMP, that is, among others, we show has really significantly affected the effectiveness of the program. And the evidence suggests the program was quite effective. Less than 10% of eligible borrowers took advantage of the program. Importantly, there's not evidence of a widespread gaming of the program. Those that took advantage of the program look like the ones that needed it the most. And importantly, vast majority of them, once debt forbearance expired, resumed making payments. And important distinction between forbearance and debt forgiveness is that a temporary reduction in payments, but it doesn't necessarily mean that you're gonna, get a permanent debt forbearance. So it's, less incentives to also game such programs. And our work shows, that there was a big spike in unemployment, but we didn't see increase in delinquencies. And, the work we've done on this suggests that, the debt forbearance allowed us to essentially prevent around 1 to 2 million mortgage defaults that would happen otherwise. So in some ways, the debt forbearance accounts for the absence of household debt distress during COVID-19 crisis. Of course, this crisis is very special. The shock was transitory. There was a lot of other stimulus measures, but it just makes us think that we can potentially provide debt relief in a cost-effective and more incentive-compatible manner. Also, I encourage out for, maybe this is for the future work, to push more on the normative implications, thinking about public versus private solutions, why we really need public intervention. The author discusses it, as you have externalities, private benefits of modification that are not internalized by the servicer that provide some rationale for that. Maybe nice to think more broadly about what is really the right social welfare objective and how the debt relief design should be implemented. In particular, one way to do it is consider ex-ante mechanisms. For example, state contingent mortgage contracts with maybe flexible repayments or refi options. I done some work about it years ago with Alex Sechisti when we thought about, improving the mortgage contract with a loan with a flexible repayment scheme and maybe adjustable rate feature to allow the quick pass-through of interest rates. Such contracts are not so easy to implement effectively in practice. You need the right indices, you need the right understanding of risks. Alternatively, we can use ex-post stabilization programs like HARP. They can be better tailored to specific crises, but you need to think about implementation frictions and the speed versus quality of these policies. And of course, in doing this, we need to account for various underlying frictions, including also the broader consequences of these programs, including G effects and redistributional effects. Let me make a last comment on data and model estimation. So the model is estimated using prime, final and fixed rate mortgages in California. But the prime FRNs, the GSE loans, the defaults were the lowest. So it's possible that we might be underestimating the quantitative impact of HAMP. So I would really encourage the effort to expand the sample to bankhead loans, Alt-A subprime loans, including also non-agency securitized loans. And this is just an example of the default rate. So in some ways, the effort focuses on the blue loans, the prime fixed rate mortgages. But we know that the subprime loans had a much higher default rates. This is where most of the distress was concentrated early on in the crisis. So it'd be nice to sort of incorporate them in the analysis. So let me just summarize. I mean, it's a very interesting paper. The framework can be expanded to address further questions. We definitely need more work in this area. Let's take advantage that, we don't have a massive mortgage crisis right now, so we can think about better solutions now. And of course, we also should think about, the impact of big data, AI, fintech on mortgage contract debt relief policies. All these advances might make it more easier to implement some of these programs. So again, thank you again for asking me to discuss this paper.
Let's take maybe 2 questions. All right, go ahead.
Maybe a question and a comment a little bit. So I think there's a really interesting question here, and I think Tomasz alluded to this a little bit as well, of how to design these debt relief policies in terms of how much information to gather. And is it like a blanket policy, everyone can get a modification versus income verification, et cetera, like HAMP had. And so to that end, I was just curious how you're modeling the transaction costs and whether they're a function of the quality of information or even in a reduced form way, how much information is being gathered.
Yeah, thank you. So the costs are not, so the way the cost would capture information at this moment is if you're worse than, if you're a certain bank or a servicer and you're worse at collecting information, your transaction cost would look higher. Like it is kind of soaking up some different things there. Yeah.
Yeah.
Hey, so my name's Nick Smith. I'm here at the Philly Fed. So at the beginning, you noted that like this is a problem for both the lender and the borrower. And then we've talked about policy, but I know lenders also did like contingent modifications and things like that. So is this a problem that really needs policy, or is this a problem that the private market would fix in and of itself?
So some of that's outside the model a little bit. I think like there is a strong private incentive for these institutions to have figured out loan modifications, but I think there was a little bit of a coordination issue where the government did play a role in even designing HAMP, so that there was a standardized ways to help borrowers out. And yeah, so I do think if they, and I don't know what that cost would be, but if they're able to overcome that cost, then they did have a strong private incentive to figure it out. And then we have seen private loan modifications kind of develop, but a lot of them have built on the kind of legacy of HAMP.
Well, sorry, it's okay if we save your question for lunch discussion? All right, second is good. All right, yeah. Okay, let me invite our second presenter, Charlie Nathanson from Northwestern.
Okay, thank you to the organizers for including my paper, and thank you in advance to Cameron for the discussion. This is a joint work with Anthony DeFusco at Wisconsin and Michael Rayer, who is at UCSD. So commercial real estate is about 20% of the assets in the United States. So it's quite important. And about a quarter of that, so 5% of the assets in the US, serve as collateral for commercial mortgages that feature very large debt rollovers. So many of you in the room probably already know this, given this is a mortgage conference, but it's always good to review things. So the typical LTV in a commercial loan is something like 50 to 70%. And these loans, unlike residential loans, which we've been discussing, don't really amortize that much. So at maturity, essentially this very large balloon balance comes due. Okay, and this contrasts not just with residential loans, but also with a lot of corporate debt, where typically because corporations have many different debt at the same time with different maturities, your typical corporation at a debt rollover event is rolling over something like 2% of assets, which is very different from commercial real estate rolling over much more. Okay, however, there's been little to no evidence of whether debt rollover in real estate has real effects at the businesses taking place at the properties that are serving as collateral. And that's where, this is something that has caught the attention of the financial press, which was actually also discussed after the last financial crisis, that there's this wall of maturities where a lot of debt comes due. And so in sectors that are troubled like office, this has led people to worry about what is the impact of all these debt maturities, both on the financial distress, but potentially also on the economic distress that could lead to at the underlying properties. Okay, so that's where our paper comes in. We are going to look at that by assembling a novel data set that links financial level information to the real outcomes at the properties serving as collateral. We are going to look at the COVID-19 crisis and hotels. The reason for hotels is that the hotel industry coordinates to maintain high frequency at the daily level operating data, like how many rooms are booked, and what was the price paid at the level of a hotel, as well as some annual data on things like labor expenses. And the COVID crisis we look at because the sudden unexpected nature of this shock that seemed to many people come out of nowhere and around March of 2020, it leads to a natural identification strategy for us. So our strategy is going to look at hotels whose loans were scheduled to mature shortly after the COVID crisis. That will be our treatment group. And then compare them to hotels that were collateralizing loans that were scheduled to mature shortly before the COVID crisis. That would be our control group. And then we can compare both hotels over the course of the COVID crisis and look at how the real outcomes varied. Okay, so to show you the paper in one picture, here is room revenue at a monthly level for both groups of hotels. You see in before that vertical dotted line, that is February 2020. Before that, the room revenue in these two groups track each other pretty closely. And then starting in after the COVID shock, a gap opened up between them, where the hotel in the orange line that were collateralizing loans coming due in the first 12 months of COVID started to have worse operating performance. Okay, and so that gap is what we're going to be about in this paper and trying to rule out other explanations to show that it's actually a causal effect of the debt rollover. And we're also going to try to understand the mechanism behind this. Okay, so in terms of the mechanism, this is something where we don't have smoking gun evidence, but by ruling out some things and by showing some other facts, our current view is the most likely thing is that, before getting to that, just the thing that makes it a little difficult to understand the mechanism is that most of these loans were actually renegotiated. Okay, so it's not that the loans that came due during COVID that owners were scrambling to raise cash because they had to pay them off or that they were imminently getting foreclosed. Most of them actually had term extensions that were sent in 2021. And that makes it difficult because you might think there was a liquidity story where they're firing workers to pay off their debt. That doesn't seem to be going on, at least in the short run. Or a debt overhang story where they kind of gave up in the short run because they thought they would be foreclosed right away. That also wasn't happening. So that leads us to propose a story based on strategically cutting operations to actually make the renegotiation more likely by making the property less appealing to the lender by actually impairing the property. So what's our evidence for this? So one is that we'll present a model that shows in a very general setup with, I think, very few assumptions that this mechanism will hold when there's renegotiation versus foreclosure on the table. And then also we're going to present some descriptive facts and some heterogeneity that I think will distinguish between the stories. Also mention, well, I'll do this with a literature review. I think enough, just to jump into the middle here, there's a big literature showing that in commercial real estate, borrowers act very strategically. There's good evidence that there many times borrowers have the ability to pay off the loan. Like you can look at the cash on their balance sheet and they're just choosing not to, but for strategic reasons. There's a lot of papers by people in this room. So we think it's not a giant leap to think about the level of strategic behavior we're proposing here. There's also literature on corporations rolling over their debt in crises. That's a little different than what we're doing, because in those papers, what's happening is companies are facing these smaller debt rollovers and they are paying them off, but they just can't get new debt because there's a shutdown of the financial system. And so there's a liquidity shock, basically, so they lay off people. Here, we're facing much larger debt rollovers and the borrowers are not paying them off. They're getting extended, but we still find that they're laying off people. Okay, so it's a different kind of setting, even though similar idea. And then the final literature is there's a literature on what went on in the COVID crisis, both in corporations and debt, and as well as COVID-19, and well as commercial real estate. And we're adding to this by looking at, I think, a little bit of a different angle than some others have examined. Okay, so I'm going to present some descriptive facts that I think motivate our model, and the research design and main results, and then the mechanism about strategic renegotiation, and then a conclusion. Okay, so borrowers finance hotels with long-term debt that is mostly paid at maturity. You can think of the average maturity in our setting as 5 years. The average LTV at origination is 70%. Okay, so what that means is that after the COVID shock, when values fell, the real-time LTV was even bigger than 70%, right? So these are big, large amounts of debt relative to assets. And most of this balance typically is paid off in a tight 3-month window around the maturity date. So we find 80% of the balance is paid off then. It's not 100% because there's some early payments, but most of it is not paid off early because of prepayment penalties that are very high in commercial real estate. Okay, so think of these large balloons as persisting to near the maturity date. Okay, now these balloon maturities are much larger than annual operating profits. So if you look at pre-COVID profits, the median ratio is about 4 times. So the balloons are 4 times bigger than annual profits, which means that harvesting cash to pay off the balloon was unlikely to make a big difference. Right? There's only so much harvesting you can do by laying off people in the short run to boost your profits 4x, and this is pre-COVID profits, right? So, okay. The next thing is the duration of the COVID shock was very uncertain as of 2020. So people didn't really know how long this would last. For hotels, even with a vaccine, there's a lot of uncertainty about business travel, which drives a lot of hotel revenue because of work from home, right? It used to not be normal that a discussant at a conference would be pre-recorded on Zoom, but we're in a different world now. So 30% of business executives thought there'd be a permanent effect on hotel revenue. PwC thought it would take several years for hotel revenue to recover. It actually only took 1 year for hotel revenue to recover, so hotels bounce back. So I think it's some evidence that there's uncertainty about how long this would last, which we'll see is important in the model. And then finally, these loans that came due during COVID it was very common that they were renegotiated with term extensions. About 50% of them we can see in the data were renegotiated. 20% of them did actually pay off, and only 5% actually went through a foreclosure. A quarter of them actually we don't know what happened, so it could be that even more than 50% of them were renegotiated. It wasn't just registered officially in our data set. The common renegotiation was almost all a term extension. And so this implies that a fear of imminent foreclosure wasn't guiding behavior. All right, so now let me present a model of this renegotiation channel. So in our model, we have a firm with a Cobb-Douglas production function. We're going to fix capital and just let labor be a choice variable. It's going to be a discrete time model that begins at some high state at time 0. At time 1, there's a crisis that just reduces the price of output, okay? And at time 2, either the crisis will end, which means the price of output will go back up, or the crisis will persist forever and the price of output will remain at this low value. There's a probability, as of time 1, the probability of a good reversion at time 2 is Q. Okay, now the key assumption here is that the borrower can freely adjust labor. So if they fire people today, tomorrow they want to hire people back, they can do that and there's no adjustment cost. But the lender faces an upward adjustment cost. So the idea here is that it's a lot harder for an outsider to come in. It doesn't have to be the lender, even any other third party to come in and kind of rehire back all the people that the borrower fired. Whereas it's easier for the borrower, maybe they know they have relationships with the workers and things like this. So that's the key assumption. And we use an adjustment cost here to just an upward adjustment cost. And we use what's been used in the macro literature for a functional form. And finally, the borrower doesn't know what the lender's adjustment cost parameter gamma is. So how costly it is for the lender to actually hire people back. It's just some unknown thing. And we just need that there's some chance it could be arbitrarily close to 0. Okay, that's the only assumption we needed. Okay. So on the debt side, the debt is non-amortizing. So there's a balloon maturity. There's going to be a coupon as well that's due. And that's going to just equal the common discount rate R. And so the total debt at maturity, we will denote D. That includes both the balloon and the coupon. There's 2 types of borrowers. We'll look at what we call early maturity borrowers. So that means their debt is due at time 1. So that means when the crisis starts. Think of that as the treatment group in our empirical work. Those are the people who had their debt due during in the early stage of the COVID crisis. And then the second group is late maturity borrowers. Their debt is due at time 2, which is after the uncertainty about how long if this crisis will be permanent. It's due at the time that uncertainty is resolved. Think of that as the control group in our data set. So they paid off their debt in, say, 2019, but they most likely refinanced into new debt that then was just due later. Okay. So at maturity, there's going to be a game that looks very similar to the game that was actually in the previous paper. So the borrower, with one exception here, which is that first the borrower can commit to the labor for that period. So the idea is that at the beginning of COVID, the borrower can say, we're going to decide how many people we're going to fire or not. And once we do that, at least for some initial, some period, maybe a year, that's kind of fixed and you can't really change that initially. The borrower will then make the required loan payments or the borrower will default. If there's a default, the lender comes in and can either foreclose or choose to offer a renegotiation. That in this case, we will restrict to simply be a 1-period term extension. So they'll say you'll still have to pay the coupon now, but the balloon maturity will be due in time 2. Okay, and if the extension is offered, the borrower either accepts or rejects, and then a foreclosure happens. Okay, so that's the whole model. And in the interest of time, I will just jump to our main result here, which is that in this setting, in equilibrium, you will always have some amount of strategic default that comes along with cutting the labor below what the optimal level would be. So specifically, if debt is sufficiently low, then both the early and late maturity borrowers will always pay off their debt. So there's no funny business. They say it's not worth it. We just pay off. And they set the labor in this crisis period to whatever is the static optimum. So whatever would maximize the profits of the firm right now in this crisis, that's what labor is. Okay. However, if debt is higher than that, then you get something interesting. So what you have there is that the early maturity borrowers, those who face their maturity right now, they will default and they will strategically cut their labor below the static optimum. And then with some positive probability, they will in equilibrium accept a renegotiation from their lender at 1 period term extension, okay? In contrast, the late maturity borrowers whose debt is coming due next year when the uncertainty is resolved, they will keep paying off their loan and they won't cut their labor. So the reason for that is they just had to make a coupon payment, not the full balloon. So it's optimal to just make the coupon and there's no strategic reason for them to cut labor. And then finally, if debt is very, very high, then both types of borrowers will default. So even the late maturity borrower will say, it's not even worth it for me to pay my coupon payment anymore. So they both default and then the lender will foreclose. There will not even be a probability of renegotiation, okay? So what you see here is that the early maturity borrower will always have their labor be at or below the late maturity borrower, and it will be strictly lower when debt is in some range, okay? Now you might say, well, how plausible is that range? So we can show that that range actually, it starts below this level, which is the NPV of the firm as of the time of the crisis, which means that there's going to be borrowers who have positive equity, right? So they're not even underwater, they have positive equity and they will strategically default and cut their labor, okay? So it's not implausibly high amount of debt that you need before this happens, okay? And then the high debt threshold where both borrowers are identical, that's very high, that's all those borrowers are underwater, okay? Okay, so that's the model, and that explains how, and then the empirical predictions that I think are nice is one, in equilibrium, you will have both, some borrowers will pay off, some will get forbearance, and some will get foreclosure, which matches what we see in the data that all three happened. You also have the early maturity borrowers have lower real outcomes than the late maturity borrowers, both in terms of labor, revenue and output, and also profits. So that they're actually shooting themselves in the foot. So which I think is a different prediction than many other models, like it's about liquidity, they're trying to harvest cash. Right here, they're actually going to have lower profits because they're cutting labor below the static optimum. Okay, and the effect should be concentrated at higher debt levels. So excluding the really high category, you would only see effects for high LTV. Okay, so now we're going to go to the data. How much time do I have?
You're at 11.
Left or total?
No.
N? Okay.
Yeah.
Okay, great. All right, great. That's perfect. So, our data sources are, for hotel performance, use data from STR, which Smith Travel Research. This is an anonymized panel of hotels where we see static characteristics for each hotel, like how big they are, as well as daily operating data like room bookings and annual data on revenue and expenses and their profits. You might be thinking, how in the world do we have this data? Well, it's an interesting equilibrium in hotels, that hotels, pretty much close to 100% of hotels in the US contribute their data to STR in exchange for seeing anonymized data on their competitors. Okay, whether or not this leads to collusion is an interesting question that we do not attempt to answer at all. But that's just why the data exists. Then we're going to match this this gets mapped to TREP CMBS data, which you might presume many of you are more familiar with, where we see contract terms, we see monthly data on payments, modifications, and disposition. We are going to match this to property level data from RCA so that we can look at total LTV. So because there could be second liens that don't get securitized that we don't see in TREP, we want to see those, so we do that matching. And this match to STR based on property address. So our sample is going to be hotels in STR that collateralizing loans in TREP that mature between 2018 and 2022. Our treatment group will be loans scheduled to hotels that are collateralizing loans scheduled to mature in the first 12 months of COVID. And the control is hotels collateralizing loans scheduled to mature 12 months before. Okay, descriptive statistics, I don't have time to go through this carefully. It mostly is balanced. There's actually some interesting lack of balance that we're going to try to address with control variables. And we can talk about it more later if you'd like to. Okay, so our research design is we're going to be regressing our outcome. We're always going to have a hotel fixed effect. Okay, so within hotel, then we're going to have market by month fixed effects. So we're always comparing like two hotels in this, think of market as like a metro area. So two hotels within Philly, for example, and that's important because COVID played out differently in different places. And then sometimes we'll have time varying hotel controls. And then our main coefficient of interest is the coefficient on whether or not your pandemic maturity hotel interacted by month. Okay, the key threat here is that maybe the control hotel, the treatment hotels would have just trended differently over COVID for reasons that have nothing to do with the debt maturity. That's partially addressed by I showed you parallel trends before COVID, so that was assuring. Other things we'll do is we're going to have hotel characteristics interacted with month fixed effects. So that will say, now we're only comparing, say, two airport hotels in Philadelphia or something like that. And we'll show you that in a little bit. We also have a post-maturity dummy that just takes off any loan life cycle effects. So maybe anytime a borrower pays off their loan, occupancy jumps or something, so we can control for that. Okay, so when we do that, these are now those coefficients on the pandemic dummy interacted by month. So think of this as the difference between the treatment and control group. This is monthly room revenue, the log of monthly room revenue. And we see, no pre-trend, so it's close to zero before. And then we see a big drop when COVID happens. Okay, now one thing is so like the coefficient in April is a 40 log point drop for the treatment versus control. Now you might think that seems implausibly large, but remember it's 40% off of a low number, right? Because the control group revenue also fell a lot. What I think is interesting is that it happens very quickly, right? Which to me at least makes like a debt overhang story a little difficult to explain. That why was it that in April or even in March, right? So this is within a week or two of the COVID shock, you're already seeing an effect where the control hotels are holding under they seem to be operating at a higher level than the treatment hotels. So we'll try to talk about it a little more later. But just in terms of the findings, and then we find that the effect then persists for up until January 2022. Okay, now because I'm looking at revenue, that's the product of prices and occupancy. So how much is each driving the results? So occupancy is really what's going on here. They're booking fewer guests. They're actually not differentially cutting their prices right when COVID happens. Eventually there's a pricing gap that opens up, but that's not what's driving things right away. They're just booking fewer guests. Okay, now they're booking fewer guests. So we'll talk about that in a little second, but the next thing I want to show you is what about these differential trends? So maybe the treated hotels are just more exposed to COVID crisis because they're just different hotels. So it's just all by chance that we found this. So we successfully add in finer and finer fixed effects interacted by month to just try to control for other observables. So for instance, so COM1 is our baseline effect, but just pooled over all the months after COVID. So we found a 17% drop. We then add in size by month fixed effects. So this is how many rooms are in your hotel, how big it is interacted by month, and we still find an effect. Then we add in operation type by month. So this is, are you management, what type of management agreement you have, and we still find the same effects. Location type is, are you an airport hotel or not? An origination year for the loan, and then we even have a specification with borrower by month fixed effects. And the effect still seems robust. Okay, we then look at our annual data and see for labor expense and sales and marketing expense, we find a result. This thing is relevant for the Fed since the half of the dual mandate is employment. So I wanted to make sure to show that. So they seem to be laying off more of their workers. And sales and marketing is useful because it shows that they're intentionally lowering their operations by saying posting less on TripAdvisor and stuff like that. Okay, so in terms of the mechanism, so what we'll look at now is we look at revenue. We want to show it's about strategic negotiations. We look at revenue before and after the renegotiation date. You would think that there should be things should bounce up once they secure that renegotiation. We also look at operating profits because our story predicts those would decrease, whereas something like liquidity would predict it would increase. Then we are going to look at some other heterogeneity by loan characteristics. So when we look at loans that were successfully modified, if you just plot a simple average of the monthly room revenue around the modification date, you see what you would maybe want to see from based on our model, which is that as soon as they get the modification, things start to bounce back up. Okay. Now you might think, well, this is confounded by maybe they're getting modified in the months when there's aggregate trends. So we also have this specification where we add in a lot of time fixed effects and things like this, and we still find the same general pattern. When we look at operating profits, we find that we can only see this at an annual level, but we find that it does go down more for the treated hotels. That's also consistent with the story where they're intentionally lowering their profits in order to try to secure the negotiation. And then we do this table here where we look at heterogeneity by contract characteristic. May not have time to go through this in detail, but we find that the results are concentrated among those with a high LTV. That's consistent with many stories, but also with ours, as I showed in the model. We also find that it's concentrated among loans that don't have an extension option. So some loans at the time of origination, they had an option to extend their loan if they wanted to. You would think those we would not find our effect because they didn't need to tank the hotel to get the extension. They could just say their lender were taking our option. And in fact, that's what we find. The results are concentrated among loans that did not have the extension option. We also find these stronger results where hotels don't have a lockbox in the loan. What that means is that their profits can be held in escrow by the lender. So they have kind of a smaller incentive to preserve their profits, so a bigger incentive to cut their labor. So we find larger effects. And then the last two things, I'll maybe skip column 4, column 5, just because we wanted to get some proxy for the servicer's gamma, like how costly it is for them to readjust the hotel. So we have, the best we come up with so far is to look at, do they have many other hotels that they lend against that are of the same chain as this hotel? So the idea is if this hotel is a Marriott and they lend against many other Marriotts, it's easier for them to hire people back because they know how to run a Marriott. And in fact, you see that, and then you might think that if that's the case, you're going to have to cut your labor more to be able to get a renegotiation because it's easier for them to ramp things up, and that's what we find. Okay, so just to wrap up, so some broader lessons of this for corporate finance is that renegotiation could impair real outcomes with liquidation costs or exogenous. So here, the cost of liquidation is endogenous to the level of operations of the borrower, and that could lead to some firing of people that may be inefficient. The channel seems relevant in our context, but it could also be relevant in other contexts in corporate finance. Just here, we're able to maybe isolate this by ruling out some other channels, whereas in your typical corporation, many other things are going on. And then in terms of commercial mortgage design, our work is adding to other work that's highlighting some of the real costs that these large balloon maturities can have on terms of the outcomes at the firms. And again, because this is the Fed, and I know it's not officially in the dual mandate, but macroprudential regulation is also the Fed's purview. People thinking about real estate and the effect on banks. There's a lot of attention on the LTV, but it could also be worth thinking about the staggering of the debt maturities, right? So like maybe you had a 70% loan to value, but if you had 10% loans that were all staggered, that might be a less risky thing because it would lead to less of the effects that we're finding here. Obviously, that would involve a very large change in mortgage finance, but this is the academic day of the conference, right? So throwing that out there. Okay, so with that, I turn it over to Cameron. Thank you.
Thank you very much, Lauri. Our discussion panel from Yale.
I have to scroll. Cool. All right. Thanks so much for inviting me to discuss this paper. It's always fun to do a CRE paper. I know there's a lot of great housing research, but CRE is typically a little bit underrepresented. So I think Charlie did a great job summarizing the paper. So I'm going to do this first slide pretty quickly. But the central idea of this paper is that you have firms with rollover debt that are facing these severe negative demand shocks. And one way that they can force creditors to come to the bargaining table is to potentially strategically cut OPEX or operating expenditures. And Charlie and his co-authors are going to highlight this adjustment cost friction story that allows the strategic cutting of OPEX to trigger these renegotiations. They start with some really cool key facts that I think a lot of us kind of knew anecdotally, but that they're able to show using this very unique data set of STR linked to TREP. One thing that I thought was very striking is just how large these balloon payments are relative to operating cash flows. It's something like 4x relative to EBITDA. And I think that that's important to show just because it highlights that this is not a liquidity constraint story. There's something else going on here. Most hotel loans during this particular crisis episode were also quickly renegotiated to avoid foreclosure. I think that's something that's new here. And then in terms of the results, they're going to do this very, very nice diff and diff. It's going to compare post-crisis to pre-crisis maturing borrowers to get at these negative real effects. And then they're able to actually look at a lot of outcomes that I haven't really seen before, including revenues, wage bills, sales and marketing profits, replacement reserves, which I'll get at. It's going to be key to one of my comments, and other types of OpEx. And then as the last few slides highlighted, they can do a lot of heterogeneity analysis, and it goes in the direction of supporting this adjustment cost friction story. And I think it's really just impressive how they were able to build out the full capital stack. So that's getting at that combined LTV required a lot of work. So I don't know if anyone's staying in this hotel. This is the Club Quarters, Philadelphia. It's currently in foreclosure. So let's talk a little bit about what happened there. It's gonna kind of highlight a few of the comments I'm going to make, but this was part of a loan that Blackstone defaulted on during the COVID crisis, and there are multiple pieces of property that were securing that loan, all on this Club Quarters brand. So there's Philly, SF, Boston, and then Chicago. So here's a little bit of what happened. So Blackstone made the mistake in hindsight of extending their loan into the COVID period. So this is kind of a nice, like, you know, somewhat randomized sorting into the treatment group for Blackstone. And then it was transferred to a special servicer in June 2020, and now the hotel seems to be in a D in lieu kind of state. And it's currently in foreclosure on CoStar as of last month. So I think this case study highlights a couple of things. One is that there could be some rollover risk contagion, like within the portfolio of loans that are securing the loan, as well as, you know, within the owner, to the extent that they might have some sort of internal capital market. So we could think about, you know, you're cutting your OpEx strategically at one location, what's happening to the other hotels that you own. The other thing is that, you know, I think the way that this is portrayed in the model in the paper is that this is suboptimal, this cutting of OpEx, but on some level, if it's staving off foreclosure, we know there are a lot of foreclosure externalities, and that's where we are kind of now in the hotel space. We are starting to see that uptick in foreclosures that we didn't see during COVID. So maybe there is some benefit in GE to actually doing this kind of strategic renegotiation. So my first comment is a little bit on external validity, but is this a COVID paper? So COVID doesn't actually show up that much in this paper. Of course, it's mentioned, it's part of the identification strategy. But as we all know, this was also a pretty severe and geographically clustered public health crisis. And so I was trying to think about, like, okay, I think it's a very clean diff and diff. There's a lot of fixed effects in here. But is some of this just picking up the fact that there are lockdowns and that there's not so much strategic OpEx cutting, but maybe forced by some of these lockdowns, some of this, you know, furloughing of workers, laying off your staff, et cetera. So I'd like a little bit more clarity on you know, which of these OpEx cuts are forced versus strategic, and to what extent do these fixed effects control for some of this differential exposure to lockdown mandates across the early and late maturing borrowers. We also just kind of know as a general stylized fact that, you know, they're looking at hotels here, but we can think about what would happen in other segments of the CRE market. So we know, like, this is just from my MBA slide deck, but on the left-hand side, we're kind of ranking different segments of the CRE sectors in terms of their betas or their cash flow exposure. And then on the right-hand side, there's this interesting study in review asset pricing studies that's looking at what the abnormal return or what the alpha is around these various public health exposures during that early lockdown period. So you can see that hospitality also has a very large negative alpha. So basically what I'm saying here is, if you could ideally say something about, you know, whether this early versus late maturing gap is going to be smaller or bigger for hotels versus other vertical segments, I think that would be useful for getting at external validity. I do not think this is just a COVID specific effect. I think one way you could highlight that is to just, you know, basically you do this bandwidth of 12 plus or minus 12 months around the lockdown period, maybe just cut out a window around there and just look at, like, what happens if I do the 12 months after the vaccine rollout or something. I think you've got this persistent result that you could use to get at that. And I think clarifying what the fixed effects are doing with regards to COVID, because you don't actually have that many hotels. So I think that, you know, a lot of these fixed effects are multicollinear. Second point is about the role of internal capital markets. This is not so much, you know, a problem with the paper. I think that there's some interesting further heterogeneity tests you could do along these lines. But there's a big literature showing that, you know, firms like to smooth out these demand shocks. particularly in the global financial crisis. So there's this result that like the plants within the same larger umbrella firm that get these large negative demand shocks through the housing market, they propagate that to other plants in their network. And I'm wondering, if you had something like a REIT, and it seems like you do have enough REITs in your data set that specialize in hotels, what's going on when one of these hotels gets a big, COVID shock? Or does that propagate to the ones that were less exposed? There's also kind of this labor hoarding idea that comes through in this literature. So again, is this really strategic OpEx, or is there some sort of like furloughing of workers? And I think if it's really furloughing, as we know happened during the early COVID period, then it's not clear that adjustment frictions are really going to bind as they do in the model. So I'll kind of skip this in the interest of time, but you could run a regression like this, that they do in the literature, where you've got some sort of cross-sectional variation that's coming from what COVID is doing to different geographies. And so that would be some notion of the demand shock in this regression. Finally, this is just a little bit splitting hairs on like adjustment cost frictions and strategic OpEx cuts versus like a more standard corporate finance poison pill idea. So a poison pill would be something like, I want to deteriorate the value of the hotel instead of strategically cutting OpEx in order to bring the lender to the table. So it's a slightly different idea. Of course, cutting OpEx is going to, potentially impact your valuation, but it's going to go in a different direction. And I think one thing that you could do to separate these two things is to maybe look at what happens to CapEx in your data. I know it's hard to get at CapEx, but you do have this replacement reserve variable that I think will hint at this. So as Charlie mentioned, they fix capital and production in their model. And why do I think this matters? Well, OpEx is included in NOI, so it is going to impact your valuation, whereas CapEx is not. This is like a well-known accounting trick. So it's currently a big data center REIT that's being investigated, probably by the SEC soon, for inflating its numbers arbitrarily along these lines. And we also know, and I think this is good news for you, you want to see CapEx and OpEx both fall to roll out this channel, right? And we do see that. So there's all of this stuff in the Wall Street Journal and the popular press about just how there's all these delayed hotel renovation projects. And anyone who's stayed in a hotel recently, things are just not quite up to par where they were pre-COVID by and large. And so I think you could lean into that a little bit. So you do have this kind of buried in one of the appendix tables. You use the replacement reserve as the outcome, and you see that spending on that line item also drops. You could use that as a proxy for CapEx and just kind of make a note of that. So just kind of to wrap up here, my takeaways, I think this is a really very careful analysis of the knock-on effects of CRE lending using, and I'll emphasize, non-regulatory data. A lot of the CRE papers to date are using some of this regulatory data that a lot of the Federal Reserve System folks have used in the past. I think, some alternative mechanisms might warrant further discussion, including, the role of COVID lockdowns, this poison pill idea. And I think, one thing that would be really cool maybe as a separate paper is to think about this trade-off between the strategic OpEx motivation and then staving off these potentially worse foreclosure externalities that we're now starting to see with these hotels. So thanks a lot. It was really fun.
Thank you so much, Cameron. Let's take a few questions.
Hello, Malik Hossein from the Philly Fed. So I thought it was pretty convincing strategy, but I think something that came up in Cameron's discussion as well that I want to hear your take on is thinking about these labor adjustment channel and strategically adjusting labor and things like that. So of course, reducing your labor expenses is one way to save capital, but I think something that was happening during COVID that's useful is because there was the PPP program, which subsidized you maintaining your current labor force. And so maybe that's like pushing against some of these things that might be going on. How do you think that would play into your model?
Thanks for the question. Yeah, first, thanks a lot to Cameron. There you are. Yeah, that was an excellent discussion. I really appreciate it. In terms of your question about PPP, that's also something we thought about, and I think it's maybe one of the appendices, we match PPP to the hotels, And we don't find any differential take-up of PPP across the two groups, which is also kind of interesting. There's good low take-up rates in general, but yeah, so doesn't seem to be driving what's going on.
Thanks for your great paper and discussion as well. I had kind of two things I was wondering about. I was wondering in your modeling if you could say anything about how large and how fast depreciation, particularly in CRE or hotels, can be important. So if they're reducing, their operating expenses, cleaning the rooms, whatever, if it kind of seriously degrades the quality of the rooms. And then the second thing I was wondering is partially a data question, if you thought about the extensive margin of your outcomes. So I was thinking about who's making these capital decisions and what kind of management decisions they have, especially the kind of how extreme the COVID shock was. Are they deciding to shut down some of these hotels? So in terms of your occupancy outcomes, are you seeing some occupancies drop to zero? And is that partially why the size of your results is so high? Or is it that kind of marginal effect that it's just a difference between 60 and 40% for most of the hotels?
Yeah, thanks for the questions. And the second question, I think you're saying, what about closures? So the results I showed here, this is conditional on staying open because we're taking the log, but we also look at closure, and we also find effects there that they're more likely to close. Imperfect measure based on if they stop reporting to STR after dropping their occupancies severely, but we find that. In terms of the first question, the speed of depreciation, we don't model that now. I think it's an interesting thing to look at it, and like Cameron touched on that, which I thought was a really great comment. My own view is that it probably doesn't explain what's going on in the first month or two because it probably doesn't depreciate that quickly, but it may very well explain what goes on later. And we also, you see that pricing differential open up over time, and it could be that they become a lower quality hotel because of this, and maybe that might be what's going on.
Can you actually expand a little bit more on the pricing? In particular, I'm thinking if you have this incentive to try to make your kind of have lower occupancy, have other things going on, why would you kind of lower pricing to match a new kind of lower quality demand? It seems like if you want less people in the hotel and you want less people working in the hotel, that you would actually not necessarily want to cut prices, and you might want to have a price mismatch if you wanted to scare people out of the hotel. I'm wondering if you can just talk a little bit more about the pricing, the long run price decline.
So you're saying why didn't they cut prices on impact, or why did they cut it later?
Prices on impact.
Why did they not? Yeah.
No,
so
why did they cut prices on impact? I'm thinking if you want less people in the hotel, you shouldn't cut prices.
I see. Yeah. So my understanding of the result is on impact, they did not differentially cut their prices relative to the control group. So on average, the hotels cut their prices about 30%, like in March and April, but that was on average the same between the treatment and control. Now, maybe you're saying, well, maybe they should have cut their prices even less, right? So, but the way I think about it is that would hurt their profits, but wouldn't really make it harder for the lender to reopen the hotel later, right? But what matters to the lender is what's the labor that is on site. And, so that is the main choice variable. And then once the borrower picks that, then maybe they're price taking, and the price is just a function of what the market will give.
Hey, nice paper on the mechanism. I agree with what you said, that the immediacy of the effect is really striking and helps to rule out lots of alternative mechanisms. I think one thing that came to mind for me that might be consistent with your basic pattern is that I think in order to get one of these extensions or modifications, I think the borrower oftentimes has to show some commitment to the property, and that can involve some like investment of cash. And so if that's what's going on, maybe you sort of cut expenses to try to raise some kind of cash.
Thank you. That we do see some of that they do. Sometimes they do put in capital, like you said, they pay off some of the debt. I think ideally, if that's the story, we'd want to see that their operating profits go up, right? Because somehow by laying off people, they should be boosting their profits. But it seems to go the opposite. Now, it could be that they were trying to raise their profits, but they just didn't. They just failed to do so because it was an unprecedented situation and they messed up. So we can't really rule that out. So that could be a different story of what's going on.
Hi, Keon Lee from Philly Fed. So two quick questions. One is, what's stopping the control group from also decreasing since this was a big shock? And they also have it, it was possible for lenders to see this big shock and renegotiate pretty early, even if the maturity wasn't coming up. And then the second one is, I think there's a first piece that might be a little bit missing, which is, do you actually observe kind of a effect of having lower OpEx on renegotiation and the terms that you see? So you could do that for loans that are renegotiating regress, the terms that they get on the decrease, the size of the decrease of the OpEx during COVID. Also, you could do that on other non-shock periods to see if that actually matters in the renegotiation.
Okay, thank you. That's a great suggestion. The first question, why did the control borrowers not get renegotiated? So in the model, they only have to pay a much smaller payment, just the coupon payments. And so if they default on those, then they risk getting foreclosed on. And so it's not worth it for them to do so. And so it's better to just wait until time 2. And then if it's a bad state, then renegotiate that. In terms of the data, I think that may be what's going on. They were making their payments, so there's no reason to renegotiate it that early. That's a great question. You're thinking like mortgage insurance? Is that, or?
Either some kind of mortgage insurance or maybe an insurance that, maybe if the hotel could fake an adverse event that was not strategic, maybe there's some sort of insurance that is gonna protect the ultimate chain. And so this is a faking of, it's them being strategic, but trying not to look strategic to get an insurance claim.
I see. Yeah, I'm not familiar with the insurance markets, and on this, there's none that I haven't come across any that would insure against default on the mortgage. In terms of faking things, there's an interesting paper by Andros Gent and some co-authors looking at this about how they write down a model of how borrowers have an incentive to look worse than they actually are to get renegotiations. So that seems to be another story to understand this market.